Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's January the 30th, 2017. Well, this is our first video clip of this year, and I want to cover off a couple of things for you. It's been an exciting year already, and we expect 2017 to be a year of lots of surprises, which should give us good opportunities in the market. So the first item I just want to mention very, very quickly is this whole area of what is called CRM, Client Relationship Management 2. And so we have just sent out statements to all of our clients who have been with us over a year. And this is a new regulatory requirement from the Ontario Securities Commission. And there's basically two components to it. The first is a full breakdown of all of the fees that you would pay to us, to National Bank as the custodian, and so on, to any fund companies, although we really don't have any mutual funds in our lineup. If we do, they're only just a very small number, which we are working off of our books. But the whole purpose is to show you a breakdown of all fees, so there's full disclosure. This really isn't a new thing for our clients because we have largely given you a complete breakdown of our fees. What you're getting now is, in addition to what we've provided in terms of our investment fees, you now have a full breakdown of all fees or commissions that would have been charged by National Bank as the custodian and trustee. That's number one. Number two, there's a performance reporting package that now goes out to you so that you can see what the performance was over the last year, and that's all after fees. So after anything, all of the charges and so forth have been deducted. For clients that have been with us over 3 years, we actually provide 3-year numbers. So we actually go back 3 years, which was more than what was the requirement of the Ontario Securities Commission. So that's a new reporting package. Expect that at the beginning of every year going forward, and you'll be receiving that. If you have money in other places or other financial advisors, or you have it on a discretionary account that you run yourself. Again, these are statements that you'll be receiving from financial institutions as a result of regulatory changes. So that's CRM. Number two, just a quick update in terms of the market. The market post November 8th. I think everybody knows what happened November 8th. We had the U.S. election, and for some people that was a surprise that Donald Trump was elected. The market's been on wheels up until today, which we see the market's off a fair bit today. And so the market's been propelled forward, and it's done very well. But I just want to offer, again, a couple of points in terms of getting into our mind and into our sort of the psychology of Rocklinc Investment Partners. We want to be careful. I really want to warn people. We are continuing to invest money. We continue to take advantage of opportunities, but valuations are not cheap. And in fact, many of the stocks are already kind of discounting future tax breaks, which Donald Trump has promised, and also the reduction in burdensome regulations, and there's lots of those, and fortunately Donald Trump is interested in cutting those back. But the point is that a lot of good news has been factored into the stock market, so we need to be even more careful and more vigilant in terms of our investing and what we're buying and making sure we're getting good value. Because I want to remind you that the same challenges exist in the market. In fact, Donald Trump, if you just look at the U.S. market, has been handed a big, big, fat financial mess. And it's not going to be easy to get out of. And I just give you a sense of how big that mess is and what's happened over the last few years. There's a chart that's going to go up, and you can look at that very quickly. And what it shows is this U.S. fiscal mess, I call it. And you can look at just two simple statistics. Back in 2008, comparing two numbers from 2008 to 2016, just to give you a flavor of the deterioration in the financial condition of the United States, which again is the most important and probably the strongest economy, major economy in the world. The first number to look at, a ratio, is the GDP, or the total production of value of goods and services in the country per capita, per person. Back in 2008, it was about 49,000. 2016, we're at about 52,000. So you've got a net increase of about 7% in total over those 8 years. Look at the debt. If you go to the bottom part of that chart, the federal debt per capita, it was, when President Obama took over, about 32,000 per capita, and when he left office it was 57,000 per capita. And that's just the federal debt. We're not talking there about state debt, municipal debt, other pension obligations, unfunded liabilities. I mean, the list goes on. Just the federal debt, that's an increase of 78%. And so you can see here that we have a debt spiral going on in the United States, and it's going to be a tough one for Donald Trump to tame. And I'm glad he's there, and we'll see what happens, but it's not going to be easy. Another chart that I'm going to put up here, and let me just walk you through that chart. It's a little bit more complex, but it sort of highlights the same issues. And you can see there on the top of the chart, it says real median household income in green, and then the federal debt per 25 to 54-year-olds. So we're looking here really at the hardcore working segment of the population, and the ones that are paying the most taxes and also sort of spending the most money. And if you look at the numbers back in 1984, which is where the graph starts, you can see that the average real median household income of that group is about 48,000. Now, if you fast forward and go over to the far right-hand side, you can see that 48,000 since 1984 has grown to about 58,000. So it's up about $10,000, a little over 25%. Since 1984 up until 2016. But look at the debt increase. It is shocking. It's stunning. It's actually almost beyond belief. The debt, the federal debt per 25 to 54-year-old was 22,000 back in 1984, and you can see how it's grown to over 202,000. So this whole issue of this massive buildup in debt is alive and well. We keep warning you about it, and we want to again just remind you this has not gone away, even with the market euphoria. We also have the unfunded liabilities. These are all the government promises, aging populations, trying to get interest rates up in the face of all this debt. It's going to be tricky. It's not going to be an easy run. And that's our whole point. So we have to be very, very careful. Other issues that we're watching very closely, given Donald Trump's presidency, there's going to be some pushback, I would assume, from China, Japan, Mexico, although they don't have a lot of leverage, and countries like Germany also. These are large trading partners of the United States that run large trade deficits. And so what Donald Trump wants to do, and I think rightly so, is trim some of those trading deficits. But if you're going to trim those trading deficits, it's going to come out of the hides of those countries. And so we would anticipate some trading negotiation, potentially some trading wars, and even currency wars. Currency fluctuations could be quite large. So it's not going to be a straight line, I guess, is what we're telling you, and nor should it be, because you're going to be reordering some financial and global relationships that have been long-standing. And whenever you do that, it's going to be, in our view, an opportunity for volatility. So we want to be very careful in terms of what we're looking at in terms of the market. So whenever you're talking about tariffs and putting restrictions in place, it's going to lead to, again, we think, more competitive trading conditions. And that's could be painful. So we're watching that. We're being very careful. We think volatility is going to increase throughout 2017 and provide opportunities to dollar cost average, buy better companies, take advantage of opportunities, and so forth. The other thing I would just point out, again, we focused a little bit here on the U.S., but you know the Canadian situation. I don't have to remind you that the financial road that we are on in Canada, given the Liberal government in Ottawa and also the Liberal government in Queen's Park or Ontario, is really a massive increase in debt. So we're under a lot of pressure. This means that we are concerned about our Canadian dollar. And so when it comes to investing, we're a little bit more biased to taking advantage of using our dollars to buy either US dollars or businesses that operate around the world that give us more diversification, more protection against possible currency erosion. We're not predicting, day-to-day moves in currency at all, but we look at the longer-term trend and we look at the leadership or lack of leadership we have in the Canadian political context across most of the key roles in this country. We are concerned about erosion of our dollar. So those are some of the highlights. If I were to talk about Europe, big challenges, significant debt problems over there. More numbers are just released today. Japan, major problems. China, major debt problems. So again, this all gets back to let's be careful. And what are we doing? Buy quality companies, that is businesses with strong business models, great reoccurring revenue streams, predictable businesses. Look for companies with tremendous safety, strong balance sheets. They can weather the ups and downs in the market. They've got good resiliency built into them. They're scarce, they're necessary businesses. Diversify. Don't just be stuck in one area or one industry. Watch the political risk. Keep our dollars closer to home and in markets that are quite secure politically. And again, have a little bit more bias to non-Canadian assets as we have opportunity to invest. Not just knee-jerk run across and run out of the country. Just take advantage of our dollar on good days when it's up and provide opportunities to buy great international assets. So that's what we're doing. So we appreciate, again, your support. And if you have any questions, please feel free to call, email, or stop by the office. Thank you very much. Bye now.